Welcome to Talk Shop, a commercial real estate finance podcast sponsored by Clear Market. Each episode, we'll bring you real conversations with industry professionals and talk about how deals are getting capitalized with bridge, construction, and equity financing. Today's guest is Derek Kirma. Derek is the Vice President of Arbor Realty Trust, a publicly traded REIT focused on multifamily and residential for-rent financing. Prior to Arbor, Derek was an originator at Banner Bank and Bank of the West. He's a graduate of the University of Oregon and currently resides in San Diego, California. Derek, welcome to the show. Great to have you on and excited to get into it. Before we start talking about Arbor and kind of all that you're doing there, would love to hear more about your background. Where are you from? Where'd you go to school? How'd you get into real estate?
Portland, Oregon, born and raised, pretty close to the Nike campus. Went to college at University of Oregon in Eugene, and I've pretty much been in real estate finance my whole life. Started off to pay for college doing home equity loans and small business loans. And, you start doing something, and there's an element of doing loans that feels like scoring a touchdown in football. Every time you get something closed, you get that rush of endorphins. And so I've just continued forth in that. And, you wake up 15 years later, and you've evolved and, doing a similar thing, but to larger scale and more complicated transactions. And so that's, it's just been sort of a long process of growing in real estate finance for me.
Awesome. And are you from Oregon originally, or?
Yeah.
Nice.
Portland, Oregon. Yeah.
All right.
Yep.
Go Ducks.
And fortunate to live in San Diego now. Been down here for around 5 or 6 years, and I'm not leaving. You're gonna have to drag me out of here.
I wouldn't leave either. Cool. So tell us about Arbor and what you guys are doing there. What's your credit box, your investment criteria? What are you looking for?
Pretty much all things multifamily related. We tend to lean a little more into the permanent debt side, but have some bridge and some construction programs. There's so much bridge going on in the multifamily space right now in general that the proportion of loans that I've done historically versus now is shifting that direction. I think you've seen a real renaissance of Class C multifamily becoming Class A or Class B. So there's a process of financing an unstabilized property that requires bridge debt, and so that's been something we lean into. But for the most part, we're focused on the permanent side of the debt. Nice.
Yeah, that kind of brings up a question I wanted to get into, just as kind of like an industry trend. The bridge to agency space has just gotten super hot. A lot of groups like yours have that as almost like a hook to secure takeout financing. Can you tell us about how you look at that program, how you're positioning yourselves in the market to compete there?
Yeah, and I think a big part of that is understanding the reason why the market has shifted that way, and a lot of it has to do with stabilized cap rates. I mean, cap rates across major metros in the nation have compressed significantly. I mean, with lower interest rates, right? We've had low interest rates since 2008, so we're talking 12 years of cap rate compression. And so when you have investment groups seeking returns, you can't just go buy a stabilized asset and get things. I mean, I'm seeing deals in even markets that were historically secondary markets. We're not talking New York or LA or San Francisco, secondary markets with cap rates in the 4s. For maybe even a partially stabilized asset. So really, you've got a lot of these investment groups digging through older Class C multifamily and looking at, well, how does the cash flow compare if I convert this thing to a Class B or Class A asset from where it is now, and that's where the value is created. But it doesn't finance as well with permanent debt because permanent programs are looking for going in cash flow. So how do you get around that issue of I've got weak going in cash flow on this property, but I want some meaningful amount of leverage on it. I don't want to come in with the 60% down that the current cash flow supports. So that's where a bridge loan comes in. You essentially are underwriting to the terminal cash flow, which is at the end of my renovation plan. Here's what I expect, and the property gets rented. Here's what I expect my cash flow to look like. We're going to underwrite to that with a short-term credit facility up front that's geared up for maybe 2 or 3 years. And then once that's finished, and the property stabilized, you come in and refinance the bridge loan out, and put your permanent debt on it, and possibly even recapitalize if you've, in addition to the bridge, if you've created, more value than the bridge loan even supported at onset. And then I was just going to talk about, so the Arbor's position tends to be less on the stretch side and more on the low rate side, where we're providing, excellent lower pricing, lower origination, but maybe not doing the really stretch projects, and I think we will do some of it for certain sponsors, but we're more focused on maybe a slightly more sophisticated sponsor with better terms. Tends to be our niche, and you'll find some groups that will charge you double the interest and maybe double the fee, but will stretch a little further on the experience. So that's sort of where we fall within the spectrum of bridge lenders.
Gotcha. So experienced sponsors, lighter value add plays, and you're bridging them to that agency takeout. I always like to contextualize that with a real deal. So is there anything you worked on recently that maybe we could use to illustrate, for our listeners?
Yeah, I mean, several, and they're really they all follow the same model where you're taking, you're taking a look at what the cash flows are currently, and so specific might be like a recent one is a 10% renovation budget relative to the purchase price. I mean, that's sort of how you get a gauge for the amount of lift. If you're buying a property for 10 million and you're putting 7 million into the renovation, like that tends to be a heavier lift than if you're, so looking at it as a percentage standpoint. So a recent one that, maybe one that I'm currently looking at right now is in the South, is a $12 million acquisition with a, $1.4 million reno budget. And that one that has going in cash flow that's pretty strong. You've got going in cash flow that's north of 1-to-1. So what that does is that gives you even lower pricing on the front end, and it also brings in a couple of agency programs. Like Freddie has a floating product right now that has really attractive pricing, but is underwriting to the current rent. So in this particular deal, we've got enough cash flow where we have an option to either do a bridge or to do a permanent product with a floating rate to give you flexibility to exit. So I'm a little, I don't want to go into too much specifics on current. I know that's always, I thought about that in advance of this. And so I need to be really careful about, not giving up too much or any private information, but also it's pretty boring if I don't give you some specifics. So yeah, so that's the nature of this specific deal that we're talking about, is because the going in cash flow is so good, you have a multitude of options to accomplish it. If we were looking at another deal that we don't have good cash flow going in, then bridges is really our only option. And I'm looking at 2 different deals right now that fit into those 2 different buckets. One with more options and one with limited options.
So when you say more options, that's a deal that has strong cash flow out of the gate or stronger, and has the option to maybe go directly into an agency loan, but would prefer to use the bridge for term flexibility and maybe just a little bit more leverage.
Well, and so the unique thing about if you have a value add deal on a property that has strong going in cash flow, you can get a little bit of the best of both worlds with the Freddie floating product right now. So you can get a rate that's very, very low, based on the as is cash flow with a really flexible prepay on a Freddie floating product if you have strong enough cash flow going in. So that's a normal agency loan has a somewhat restrictive prepayment penalty. So if you're going to buy the property for 12, put 2 million into it, and now it's worth 16 or 17, you've got an opportunity to recapitalize after that value add. But if you get a typical agency loan with a inflexible prepayment penalty up front, you can't really recapitalize after. So this Freddie product comes in there and gives you the ability to take the low rate up front, but also recapitalize a year down the road once the value add is done. So it's a bit of a hybrid between a bridge and a conventional agency program. And what gave the sponsor that option on this deal is that the cash flow going in was is north of a 1.25. You sort of got varying tiers of going in cash flow where you may get better or worse pricing. 1.25 is an important metric. A 1-to-1 cash flow is an important metric. And then if you're talking like completely vacant like that's a with no cash flow going in, that's a further stretch, and it gives you less optionality. You're pretty much looking at a bridge.
Right.
Like that.
But that's something that you can look at, something that has little to no cash flow, and you can see where the market is on a finished product and bridge in there.
Yeah. Like a hotel to apartment conversions are one that we've looked at lately. That's that scenario where you don't have any cash flow going in. And I would say experience matters more on that type of deal. You want to know that somebody has a history of being able to execute that, because you have no cash flow. It's a bigger lift. So I think matching your experience to the type of deal you want to pull off, it becomes important with a bridge, and you need to have more experience relative to the amount of lift you do.
Right, definitely. So that's a big piece of the underwriting. There is that experience. What else is maybe kind of critical to the underwriting process that is either maybe killing deals at the finish line, or some way through the underwriting process?
Yeah, well, God willing, like nothing gets killed at the finish line. Hopefully it's you're figuring all that stuff out up front, and we do work really hard to do that, because it's finish line deaths are not. It's a reputational suicide for the on the lending side. But killing stuff up front is net worth, liquidity, experience. I think liquidity tends to be one that is hard. Because your instinct is to not hold cash right now when you're making 0.05 basis points on it. It feels like it's dead money when it's sitting, and we're printing more money. M1 money supply has quadrupled since prior to the recession. It feels bad holding cash. You want to deploy it into assets, but from an underwriting standpoint, you like to know that somebody has liquidity if something doesn't go as planned. I think anybody who's been in real estate for a long time realizes that, you have a game plan, and, until you get punched in the mouth, and, and then you've got to be able to adjust. And cash sort of gives you the flexibility to adjust. Real estate can be a lot like sports. And I think that, liquidity is a deep bench. When somebody gets hurt and or there's you find out there's some sort of contamination on the property, or whatever it is, or a seismic repair that needs to happen that you didn't anticipate. Having cash set aside to cover that stuff gives you a high degree of certainty that the project's going to get done. And it's okay to make a little less money sometimes on a value add deal than you maybe budgeted. It's not okay to not finish, like that's the sort of minimal impact to catastrophic impact. So keeping, somewhere in the neighborhood of 10 to 15% of the debt and liquidity it's not a hard mark necessarily for any type of lending, but it's I think it'll give you a much better chance of getting the financing you want and making it easier and getting the lender to stretch with you if you have some money set aside to handle unforeseen circumstances that inevitably happen.
Yeah. Yeah, even if it's not something catastrophic, just little things can throw hiccups in the project, especially heavier value add, where if all of a sudden the subcontractors aren't getting paid, that snowballs, and you want to have the liquidity to carry that and ride those unforeseen hiccups out. And that's a good transition. I got a question I always ask you. Tell us a war story. You don't have to tell us all the details, but or specifics. Be conscious of confidentiality. But what's a deal where maybe you've seen the project not go as planned?
Yeah, I did think of one recently, and the real hero of this war story is my client on this one, because she so she's buying a property out of state, and she did, this is during COVID, so she's going along the process, doing everything like she's supposed to, ordering the appraisal, turning in documents. We're on the gates of closing, and the seller essentially gets a higher offer, like a higher cash offer, last second, and he's got a lien on title that he hasn't released from an old transaction, so we can't close until title is square. So we're sitting there waiting for him to get the lien released, and he just drags it out beyond the close date and then goes dark. And so she really showed me how important tenacity is to being successful in real estate, because she fought with this guy like in court for 6 months, just to win the right to buy the property, and she did, and we closed it just fairly recently, but it took 6 or 7 months. She had to spend a lot of money, and she had to rates up moved in the meantime, because you've been watching the treasuries. So she wound up, we still did really good for her. Like, we made some exceptions and, tried to ease the burden of that. But she spent a lot of money between court and then getting third parties updated. And she finally made it happen and closed. And, when I talked to her, she really said she just did it because it was the right thing to do. Sometimes, there are financial decisions, and sometimes you just do things because it's right. Principle matters. And having the tenacity to follow your principles despite short-term pain, can really help you win the war. And I think approaching it like that this is, I want this transaction to go easy. Like, I want things to go smoothly and not have problems, but if I have problems, so help me God, I'm going to make it happen. And that's an important lesson, I think, you take forward when you're getting into deals, is you've got to have tenacity and see it through.
Yeah. So what did he end up having another buyer that came in and try to, how did that end in the short term?
I don't fully know, like that's sort of what I heard from, sort of through the grapevine, that there was, maybe a better offer. But it didn't matter because he was in contract, like he had a legal binding contract, and then it didn't, and then he drug it out himself, beyond the close date. And it was just, I don't think most people would have. I think from a legal standpoint, it was pretty obvious. I'm not an attorney, of course, but from my perspective, it seemed like within the terms of the agreement, it was pretty obvious he had an obligation to sell the property. But most people are not going to. If you do that, you pull out. Most people aren't going to take you to court over it. Most people are just going to go, financially, it's not worth it. I'll just find another property, and not deal with this. But there's an element of principle, that really mattered.
Yeah.
To her.
Nobody wants to lawyer up and go to court. It's expensive, and but
Yeah.
I think good for your client for doing that, because there's not a lot of oversight, and that's her way of a little bit of being the oversight there in this
Principle, just
industry.
doing the right
Yeah,
thing, just doing the right thing. Like, she said her dad, was in her head, like saying, just do the right thing, I mean, he, has passed away, but so it was just the memory, of him, like saying, do things because it's right, like, because it's principle, it's the right thing to do. It's not always, nickels and dollars and cents, may be the right thing to do. But I mean, long term, I think if you go into transactions expecting to to be tested and and to be pleasantly surprised if you're not, because not all are, a lot goes smooth, but you go and expected to be tested and rely on your principles to get you there. I think things really work out well in the long run.
yeah, definitely. Um, so maybe I was going to get into our current event topic, but we've kind of already covered it with bridge to agency space. Maybe give us a little bit more insight into how decisions are getting made within the organization. What can a sponsor expect? Beyond showing their net worth and liquidity and their track record. What's the due diligence process like?
Well, so we're all non-recourse. So for the most part, like, other than those basic tests on the personal side, do you have experience? Do you have the net worth? Do you have the liquidity? It's mostly property specific information. So, I mean, I think as a buyer, when you're looking at deals, if you're wanting to put permanent debt on it, you're not thinking bridge. I think it's really important to focus on the collections. Um, Figuring out not necessarily like if the property was fully rented and if everybody was paying, what would the cash flows look like? But historically, what do the actual collections and cash flows look like? We can do things to modify operating budgets and operating expenses if you have a sound reason to reduce things, um, but how the property has been functioning for the last 3 months, really, like, is really something to to be cognizant of when you're going in, and sort of temper your expectations of the financing accordingly. In terms of leverage, it shouldn't affect the pricing too much. Like, the pricing is all good. I mean, we're talking treasuries in the 150 range, and I mean, historically, it's unbelievable. And we've been here for 10 years, so it seems that we are in a secular decline for interest rates, and maybe there are sound financial reasons that that's happening, an aging population, global low rates, like with Japan being near zero or negative, Europe being near zero since really 2008. I mean, there are good reasons why you can expect that, um, but yeah. So that won't really affect the financing, but the collections will really affect your loan sizing. You know, you, That sort of dovetails into the bridge conversation again, where if the collections are too bad, like, we're starting to slide back into the bridge side of the house. But for permanent debt, like, really focusing on historical collections rather than the rent roll or the market rent roll. If you're looking for permanent debt, if you're a newer buyer that doesn't necessarily have the value add experience, like, the best way to start is with a permanent product. Something that's maybe commensurate with your net worth, commensurate with your experience. Get one or two of those, season them for a couple of years, and your options will really start to open up for you. You sort of graduate into more sophisticated debt products as your experience meets it. And so, speaking explicitly to the permanent conversation, like, looking at how is it actually doing right now is a really important concept, and something that's a little bit counterintuitive, because we're all optimistic creatures, and we look at, maybe not everybody, a lot of people in real estate are optimistic creatures, because it takes a leap of faith to spend a lot of money on properties sometimes. And so you have to have a sense of, I'm going to make this thing work. This thing is going to look really good. But when you're financing, you can't focus on that unless it's a bridge. If you're financing with permanent debt and it's one of your first deals, you really have to look at how the property has operated for the last 3 months.
Yeah. There's always a little bit of push and pull between the sponsor who's, like you said, very optimistic, and credit decision makers who, have to look at the project in a critical light. So I guess the takeaway there is know how that property is operating. Really, dig into what's the historicals. Don't just go by market.
Yes. Yes, create
Um,
your own operating budget. Like the operating, the offering memorandum from it should not be your operating budget. Like you should create your own, even if it's very close, because some OMs are good. But you should really create your own and really understand the cash flows. But I love the optimistic nature of real estate investors. I mean, that's what makes the job, fun most of the time is the excitement, around a new deal and how it's going to work. And those are some of the most rewarding deals, like when you hit your projections, or exceed them. I mean, you see that happen too sometimes, where you actually get more rent than you thought, or your expenses were lower than you thought. Um, so the optimistic nature of it is what makes it so fun. But you have to, at least when you're doing your underwriting, you have to really focus on the now rather than the future. And
right.
that's a tough dichotomy for optimistic minded individuals sometimes.
Well, you always do a really nice job of striking that balance, and you do it early on, and it's intuitive, and second nature to you. So it's always fun to run something by you in an early stage. You're able to hit that, pretty much on the head. So um, let's kind of wrap it up with a good deal. Tell us about what's the one of the best transactions that you've worked on in real estate. Could be with Arbor, could be personal deal. One here.
Yeah. Well, I mean, since we just talked about the war story, that was almost the best one, was closing that one after all of that. But in general, the value add deals where you're executing the exit better than what you thought. And I have a recent one that was in the Northwest. Um, that was like that, where we're refinancing it actually wasn't a bridge loan that we did. It was a bridge loan that somebody else did. Um, but I looked at it up front, and they hit their metrics, and exceeded them. So we wound up being able to recapitalize them better than we initially thought. And what made this one extra good was the interest rate, like where we came in coordinates with like the grid pricing. And I think this is sort of an interesting nuance to how Fannie Mae loans ultimately lock their interest rates. Um, you have a Fannie Mae. So this is when we're going to the exit. This is the permanent, like we're locking the rate. When you're going to lock that rate, there's almost a bidding process. I mean, there's a bidding process that happens for that debt instrument. So you've got like the Fannie Mae grid, and then you've got all these investors that could be, a middleman for another investment group. They could be a REIT themselves. They could be representing a pension fund, but they're buying these bonds because they want fixed income, and they're all bidding for the transaction at the last second. So that's a so it feels almost like eBay sometimes, where you've got somebody offering, okay, I'll do this one at 3.25. Okay, well, I've got one at 3.25. What about 322? And so for this particular deal, where they exceeded their cash flow expectations, we we came in roughly 15 basis points below the expectation, below the grid, because the bond buying process went so well. That auction was so competitive. There were so many people interested in this particular bond that they bid it down 15 basis points below what we were expecting. And so the buyer wound up, the sponsor wound up getting a bigger loan and a better rate, and having a project that just totally like met their most optimistic potential range of outcomes, like for all levels. And so you feel really good when you have that sort of thing happen.
Yeah, it's nice to return a lot of that equity in the refinance there. That brings up kind of an interesting insight into the I guess the secondary market side of these transactions. You actually have bond buyers, fixed income guys bidding on specific assets before you lock that rate. Who manages that process?
Our capital markets team, I'm really lucky. Like we have a really strong, like seasoned capital markets team, and relationships matter a lot to these guys when they're when they're going out to the various fixed income buyers. So yeah, we have a whole team that really doesn't do anything besides like just manages the pricing and the bond process, and these guys work really hard. I mean, and I think that's really one of the biggest difference makers you can have, when you're doing.
So you've got the grid, and that's indicative of what to expect, but you can actually have your team go out there and outperform that when it's time to lock.
Most times they do. Yeah. I mean, like you don't, expectations, you want to set them at the grid if you can early on, because you don't ever want to come in below, but yeah, no, most of the time they do. Most of the time they do exceed, and they work really hard to do that. Their jobs would be a lot easier if they just took the first thing that came across, but they work hard to shop, because they know how much of a difference, a couple of basis points can make over the long run.
Awesome. So, well, that's great kind of, I wasn't aware of all that. So it's interesting to hear. And kind of to wrap this up, I guess, what are you looking for if there's a sponsor out there that has a deal that might be a fit? What's the best way for them to present that to you and get in touch with you?
They should call you first, and then you can call me, and we'll work together on it. I mean, that's one of the best parts about, my structure is I have, a select group of professional colleagues like you who we work together on deals. We'll talk through the spreads. We'll understand the sponsor together. So, if you borrow with us, like, you have a whole team looking out for your best interests. And call Max, and we'll work together like we always do.
I appreciate the plug there, and I appreciate you coming on. It's been a great chat. So we'll look forward to doing something soon.
Sounds good, man. Appreciate your time very much.